The Fed just hiked rates by another 75 basis points. We're going to cover what that means for mortgage interest rates going forward, the real estate market as a whole, and the bottom line on what you need to know to succeed in this real estate market. Good morning. The Fed just hiked interest rates by another 75 basis points as part of their ongoing fight against rising inflation. They did comment on what we can expect going forward, and we can expect to see ongoing increases, but the size of those increases is a bit more up in the air at this point. In the most recent press conference, Powell gave some indication that a large increase could still be on the table. We'd expect that to potentially be another 75 basis points, but it is going to be dependent on the data points that are received between now and then. We'll want to keep a close eye on what that looks like and keep you up to date. Mortgage rates are not directly tied to the Fed rate and have actually improved following the announcement of this 75 basis point rate hike. There's a couple things to keep in mind with that. Rates are not directly tied to the Fed rate, although they do influence one another. And also, you want to keep in mind that there are future expectations baked into the bond markets and equity markets. So when a rate hike is anticipated, that's already priced in prior to the rate hike actually being announced. So a couple important things to keep in mind. The Fed really has a difficult job at this point. They're looking to try to balance between this ongoing fight against inflation, which impacts our economy in many different ways, and also trying to avoid acting too swiftly and causing a major recession or worsening a recession. And that's certainly been a topic of conversation, especially recently. So Jake, tell me what you're seeing and what information we have about that R word, recession. Are we in a recession? Are we heading towards one? Where do things stand?
Yeah, thanks, Kyle. Well, to educate everyone real quick, a recession is officially defined as having two consecutive back-to-back quarters of negative GDP. And Q1 of this year was a negative quarter. And also we just got the reading for Q2 and it came in at a negative 0.9. So by the definition of a recession, we are in one. How bad is unknown, and there are some experts who are waiting and really paying attention to the unemployment rate, which we are starting to see go up before they officially make that announcement. Bottom line, whether we're in a recession or not, growth is notably starting to slow down.
Yeah, absolutely. And speaking of slowing growth, we're also seeing some slowing growth in the real estate market. So one of the important data points that we look at is a pending home sales report. The most recent report we have is for the month of June. This measures the signed contracts that we had within this month. And in June, that month-over-month comparison was a drop of 8.6%. So that's a significant drop and far weaker than the 1% decline that was expected. That puts us at sales being down about 20% now year over year. So a significant decrease in the amount of transactions and home sales that are occurring compared to the same time last year. Interest rates did reach their apex in June, which definitely has an influence on the buyer side demand. Rates have improved slightly since then. The Mortgage Bankers Association, or the MBA, did release data showing that rates have declined to about 5.74% on average. But of course, 5.74%, that is a lot higher than what we saw last year. In fact, that's about 2.75% higher than where rates were at this same time last year. So certainly that's going to have a significant impact on the real estate market. Now, as far as home values go, we've seen a lot of strength still in the home value side of things. The National Case-Shiller Home Price Index, which many consider to be the gold standard for appreciation, showed that home prices increased about another 1.5% in the month of May. That puts us at about a 19.7% increase year over year. So pretty blistering rate of appreciation still at this point. Home values have continued to be very strong. But keep in mind, this, like many other data points, is trailing information from the month of May. So we'll want to keep a close eye on that and see what things look like going forward. Of course, a big impact on what home values are going to look like in the real estate market as a whole is going to be mortgage interest rates, and tied to that is the rate of inflation. So Jake, tell us a little bit about where things stand currently with inflation and what we're seeing there.
Yeah, absolutely. So to boil it down and keep it really simple, interest rates for mortgages and inflation are basically married. Where one goes, the other's going to go. And now the problem with that is that higher inflation and therefore a higher cost of gaining capital is going to act like a kryptonite in an economy that has become so accustomed to low inflation and cheap money for many years. Now, there's two primary reports that the markets and the Fed are looking at. The markets tend to look at what's called a CPI report, which we just got the numbers in for June, and that came in at showing inflation rate of 9.1%. Now, based off that number, that is the highest rate of inflation since 1981. The Fed, they tend to pay more attention to something called a PCE report. And there's kind of two types of the PCE. There's the headline inflation and then there's the core inflation. Headline inflation, which is everything, came in at 6.3. Core inflation, with some things removed, came in at 4.7. What we're expecting to see in June's numbers is that the inflation will come in around 6.7. So things continuing to get even worse. And part of this is because as the 2020 numbers year over year get replaced by 2021 data, the inflation has been worse. We've seen that in the rising interest rates. And basically, the markets are reacting to that. With the June report expected to come in at 6.7, depending on exactly where that comes in, it's going to put additional pressure on the bond market, and interest rates rising further is not going to be unheard of. Although some relief should come in Q4 when all of these Fed interest rate hikes start to dig in with their teeth and really have an impact, probably starting Q1 2023.
Yeah, so definitely a lot of factors to keep an eye on. Just based on the few things that we discussed today, you can tell there's a lot that is shifting within the overall economy and the real estate market, and a lot of data points to be aware of if you want to be informed and positioned to have the most success in navigating through these conditions. So that is our aim in providing this video series, The Bottom Line, summarize where things stand, what's going on, and bring you a weekly video that you can take a few minutes, understand the most important data points on where things are at and where they're expected to go, utilize that in your business, and then focus your time on growing your business. So thank you for tuning in. Please check back every week with us as we'll have more content and information for you, and have a great day.